man. You're in charge of hitting record. Hang on one second.
I did already.
Are you kidding me? You always do that to me. Oh. Is that too loud? All right. Hello, everyone. We're doing the Real Estate Roundtable, the once-a-week real estate show that we try to bring valuable content to everybody about real estate. And this week, and the first Wednesday of every month, we do the real estate news. And so we're going to cover a lot of the real estate topics that are top newsmakers for the month of February. I'm your host, Jayson Bates. I also host a podcast right here in Phoenix, Arizona called Valley of the Sun Real Estate Show. So if you're looking to purchase or refinance a home here in Arizona, I would love the opportunity to earn your business. And I'm joined by my trusty co-host here, Jorge Cuervas. How you doing, man?
Good, man. How you doing? It's good to see you again this week.
Yep. Good to see you as well. Things are going fast. I mean, we're already in March, man. The last month, past Super Tuesday.
Yeah, this week, this whole year is actually flying by. I think that's the way. I think everyone's going through that right now, and getting into March is pretty exciting. So,
yes, it is. We are fast approaching a pivotal decision in our country with the presidential coming up. Right? All right, cool. So let's jump right into this, man, because I've got a lot of things that I've gathered here over the past month that I feel are some of the top newsmakers, and we're going to share them here with you. We're still continuing to see a lot of companies, big banks in particular, having to pay quite a bit of money out in claims from faulty lending practices from 2008. Here we are 6 years. 6 years? No, a little bit longer, and we just lost Jorge because I think his cat is doing some things there. But we're still seeing a lot of big banks actually paying out big money. Wells Fargo, for example, last month just paid out $1.2 billion in claims to the Federal Housing Administration, which maybe isn't a lot because I think their margins are pretty high there at Wells Fargo, but $1.2 billion in claims is still a significant number. And that's not the only time that they've paid that.
Right.
We're still seeing a lot of the big banks paying out fines.
It seems almost.
And he's having troubles with his technical difficulties here. Hopefully he'll join us right back. Hopefully, I know it's dead air. I don't know. We'll see.
Awkward.
Yeah, it is a little awkward right now without having Jorge here. His cat, I think, is stepping on his. Your cat is stepping on your internet cable. Get that cat out of there. He's chewing on it.
Okay.
It's like National Lampoon's Vacation. The cat's chewing on the Christmas lights or something. I don't.
No, man. I think it's like a perpetual thing. I think they're gonna just keep on hammering in on all the banks, and we talked about this. Actually, this comes up every month now. But the CFPB? What's it called? Is that right? Did I get it right?
Protection Bureau.
Yeah. So that,
yep.
They said it right from I think it was in December or November. The head of that agency said that we're going to go down. We're going down hard on all the banks, and it was like a fighting words that he came out with in that one public, very public speech, and that's exactly what they're doing. So.
Last year was the year of like warning shots over the bow to banks. Hey, we're coming at you. We're looking at this. We're going to evaluate it this way. This is how we interpret the law. We're giving you fair warning. And now this is the year. And really, I should say 2014 was probably the year of the shot over the bow. 2015, the year of enforcement. And now the 2016's, turning into the year of heavy fines.
Well, but really, this all stems back from that Florida case. There was a foreclosure case there. It was one of the ghost writing, or it was one of those cases. I think it was B of A, where they it was a robo signing thing. And if that was back in 2010, I think. It was a robo signing case. It was a state prosecutor went after, I think it was Bank of America. And I got the wrong bank there, but they went after one of the banks for robo signing a foreclosure. They got the wrong house or the wrong person or something like that. And I think that's where you started seeing all this happen. There was something that happened there where the public sentiment was on the side of the government and the prosecutors to just go after the banks. And there's a lot of, good cause for that. And because you saw that all the banks got all this money, but they were literally just giving money over, and there was nothing in it for the homeowners and the people that were in foreclosure. And that's the part that didn't make any sense. And the country knew that was happening. No one could squarely put their finger exactly on it. But I think from that first robo-signing case, I think you just got this giant snowball that's growing. And now you have a whole agency that's a government agency that's dedicated to hammering the mortgage makers. And I don't think that they're going to stop. I think it's going to keep going.
Yeah, no, they're now they've got additional things on their plate, additional ammunition with TRID. Now they've made comments as of recent that they're going to go kind of light on enforcing TRID because the rollout was a little clunky.
And they went back and forth on that too.
Yeah, they went back and forth and delayed the rollout even a little bit.
Yep.
So they are, right now they're saying, hey, look, we're going to go easy. However, we are going to be looking at some things. And the obvious needs to be taken care of. And we're still seeing, and that's part of one of the news stories too, we're still seeing a lot of banks having problems with TRID and qualified mortgage. I think the average turn time right now nationally is 50 days to complete a loan, which is 20 days over what the national average was before, which was 30 days. Now, I will say some banks and some lenders are doing it better than others. I just closed a loan 2 weeks ago and it was less than 30 days. So a TRID deal. Yeah. Now it can happen.
What kind of loan
Here's the key though. Here's the key. That communication has to be of the utmost. If there's lack of communication in a transaction between realtor, title company, lender, borrower, seller, whatever, if there's a breakdown in communication along the way somewhere, you can kiss it goodbye. You're not going to close in 30 days. So communication is key. If you got good communication, and with that being said, I am starting to see, and we're implementing some changes even on our end to where as soon, and these things are out there already, but we're even fine tuning them a little bit. And that is lenders taking a more of a proactive approach and notifying all parties involved that once a file hits a certain threshold, that everybody's emailed at the very least, that file has passed that certain threshold. So that gives kind of, it helps stimulate the communication between everybody. Right. So, we are seeing some of those changes within on my side of the world, in the lending world, to try to accommodate some of that communication breakdown.
And that's really what it's about. Like on your end there's so many more people into the puzzle or into the process that is a mortgage. Like you've got all that paperwork that goes in, it's all gets signed. There's what do you guys got? You got underwriters, you got the LOs, you got administrative people in there. You got these third parties for appraisals. You got there's a whole bunch of people's hands that are all involved to get that. You're right, funders. So you have all those pieces of the puzzle. There's a lot of gears that have to be all rolling in the right direction in order for that mortgage to be secure and ready to be paid out at closing. And I think like for you guys, compared to the real estate agent side where you're really just talking about the agent. I mean, there's a lot of work and stuff, but it's one person and it's their office. And I mean it's nothing compared to the amount of work you guys got on your end.
Yeah. No, there's a lot of people to communicate with. And so, I don't know, is my audio dead? I'm hearing well on my end, and I hear Jorge, I just saw in the chat there, their audio's dead.
Yeah, I saw that too.
Mine's good. I hear you just fine. So we're going to continue on. Now I will say, banking, speaking of banking here, Deutsche Bank, as they're showing some signs over in Europe of having some troubles.
Right.
And there is some concern that there may be another quote unquote banking crisis, especially U.S. banks that are heavily invested in Europe. That may trickle over to us. I've heard some predictions at the beginning of the year that we may fall into another, recession. I hate to use the R word, but there may be another recession on the horizon here in the United States. I don't know. Yeah, I don't know, man. I'm a little skeptical about that.
Well, the problem is, and we've had this discussion before in the show, is that you don't have sound fundamentals in the economy right now. You have a dollar that's very weak. I think the Europe thing is an issue because within the European Union, you've got countries there that are bankrupt, like Greece, and how the European Union handles that is going to that they're however they handle that and what they do with countries like Greece that are part of their union, whatever you call it. That's going to have an impact over here. That does kind of carry over. The only reason why gas prices are down so low right now is because the Chinese economy is down. And the Chinese economy is down because manufacturing is down. So it all has a cyclical effect and stuff. And I think that the election, kind of where you started before, the outcome of the election, I think everything is sort of on hold until that happens. I think that every industry is sort of behind the scenes, just wants to get the right person in there to I think everyone knows that it's not going in the right direction right now. I think people, even without understanding all the complexities of the economy and GDP and everything else that goes on with it, I think everybody knows that the fundamentals aren't right. The confidence in the marketplace isn't there for the future. Like no one is thinking that, the economy is great and we are everyone's looking forward to rainbows and leprechauns and everything else in the future. So I think there's a consumer confidence level that's just not quite 100%. And I think when you have all these factors in there, I do think it's possible. And we haven't really fixed anything from the 2008 crisis. Lending standards are down, but we talked about this a few months ago, how the lending standards are up, but then there's all these exceptions that have been added since the crash. We've got you've got lower thresholds for credit scores, and you've got the impact, I think, of FHA loans has something in the long term also. So many homes.
There's a lot of pressure, though. There's a lot of pressure to lower the standards even further. A lot of political pressure.
Right.
So we'll see where that goes. And I've got some news on that as well. Some rollouts coming here in the near future in regards to that. I want to touch base here real quick. Scams. I thought this was kind of funny. Actually, it's not funny because this is bad. But it's right in your neck of the woods. It's right there in Chicago. A Chicago woman was charged with posing as a federal housing official to scam homeowners out of cash. She would call homeowners and say, "Hey, your house is going to get foreclosed on. I'm with HUD unless you wire some money to this account."
Oh wow, that's a new one.
Yeah,
that's really a new one. Wow, that's
her name. I think
that is evil. That is pure evil.
Wallace, and she's 45 years old. I guess. As the housing market tends to recover, I guess we're going to see some more of those scams. I guess. Wow. Kind of sad, but there are those scams out there. So be aware of those scams. I just thought it was how arrogant. I mean, how stupid can you be posing as a HUD official? But
I don't know.
I mean, you're smoking some crack, I think. Now, on a little bit more of and this is more, I think, more to us here, at least in the southern United States and some of the warmer climate areas. Canadians, we're seeing a lot more Canadians starting to sell. In 2010, 2011, the Canadian dollar was very strong against the U.S. dollar. So we saw a lot of Canadians purchasing homes. And maybe you see that in Chicago, since you're just kind of right across the river, or kind of lake, I guess I should say. But here in Arizona, we saw a ton of Canadians purchasing homes down here, so much so that a lot of banks were looking at their Canadian foreign national programs to try to accommodate some of these Canadians, because a lot of banks were desperate for loans at that time. But now, because is their dollar, is it called the loonie? Is that right?
It's got a funky name like that. I don't know what it is, but it's something like that.
Yeah, like Looney Tunes. So anyway, the headline reads, Canadian snowbirds in sell mode because of lagging loonie. So, I guess it is a loonie. I don't know, dollar loonie. But they're selling, and I'm seeing that here in Phoenix, Arizona. a lot of Canadians are starting to sell the asset. And why not, right? I mean, appreciation on the homes has come up since they purchased. It's kind of one of these seesaw effects that's happening there in Canada. The dollar was strong. It went a lot further than what it had before. They could purchase cheap real estate here in the United States. Now that real estate is increased and they're cashing their chips in. Kind of makes sense.
Yeah, it makes sense. It's just a good financial decision. But I think most of those Canadians, they do end up going down south.
Yeah, no, we've got a lot of Canadians here.
Yeah, especially south. They're in Mexico too, and in Central America and stuff like that.
Yeah, big time. So I thought that was, now here in Arizona, we have depending on the price range, we have a little bit of a shortage of supply. Anything under $200,000 is really almost multiple offers, still very high demand. The multi-million-dollar properties, not so much. Last year they were doing very well here in Arizona. That $300,000 to $500,000 range is actually kind of normal. And then once you get into the jumbo products, it starts to slow down a little bit. But anything under $200,000 for the first-time home buyer, the inventory is really, really low. So,
well, it makes sense because you got this. You got very low inventory. You have high buyer demand. You have high rents. Yep. So it just makes total sense. But like that key thing there is like we just talked about the economy. If the economy was doing well and if everything was going well, we would see more price appreciation, and then you'd have new construction kind of starting to really take hold and stuff like that because you've got no inventory. It's like that all across the country. But it is that because the economy is not where it needs to be right now, we have very minimal price appreciation, and that's directly tied towards the housing affordability index. So, which is just basically just says people basically need to have raises, and their incomes have to go up in order for them to be able to afford higher prices, and that's kind of like the that's a crux that we're at right now. Yeah.
Now with Super Bowl was last month, right? Beginning of the month.
Yeah.
Right. Kind of a boring game, dude. I gotta be honest, man. That game was horrible.
What?
Yeah, you didn't even watch it. But big newsmaker, Rocket Mortgage, right? Quicken Loans launched Rocket Mortgage. During the Super Bowl, spent tons of money on that Super Bowl ad, and the backlash was crazy. I don't know if you read Twitter, the tweets that came of it, saying how irresponsible Quicken Loans was. Some things are meant to be difficult to get, like purchasing a home. It shouldn't be at a click of a button, and so on and so forth. I'm still seeing a lot of Quicken Loan ads even now. They've even kind of revamped them a little bit to try to encourage homeownership. I think they're trying to touch with the millennials, just from being able to apply on your phone and making it easy. And we're an ATM type of society anyway. So anytime you got to ask for a pay stub, it just kills somebody. But I think the big news here is that at least a company is willing to try something. And I think Fannie Mae and Freddie Mac are going to go down that same path. We talked about some of the automation that they're going to have, and I've got a story on that as well that I'll cover. But I think the Super Bowl and Rocket Mortgage in particular is a direction that we may not want to go because we're not ready for it. However, I think it's a direction that we're probably going to go at some point. Just a question of when.
Well, I think that's exactly because the process doesn't make any sense. It's a very complex process, and it should be, but for the younger generation, all the extra paperwork and going to the actual mortgage office and not being able to do that from your computer or your phone, it doesn't make sense to a whole new generation of people that are not right now entering the housing market. So it makes sense that does have to change. There has to be a better way to process that paperwork and to get that information to you guys.
Here's what I think is going to happen is I think, and Fannie is already going to do this. If employers register with the work number, for example, that's an automated number that we call as lenders to verify somebody's employment. And it tells us their start date and how much they make, hours, and all that kind of stuff. If that work number could integrate in with, say, Fannie Mae and say, hey, you can pull the information from here. Why do we need a middleman, the lender, to call when we can just go straight through Fannie Mae. I think that's the direction it's going, because Fannie Mae is already going to roll out that automation to where if certain employers do register, and I'm not sure how that's going to work, or if there's going to be if there's an incentive for employers to do it. I'm not sure how that works or going to work. But Fannie Mae will accept if the employers use that particular vendor that Fannie Mae authorizes, they will accept that, and therefore you will not have to provide pay stubs. If you've been there long enough, W-2s, tax returns possibly. So Fannie Mae is even kind of recognizing that. So I think Quicken Loans is just trying to get a jump on that by offering this rocket mortgage. Now, they say that they have vendors, in all defense of them, they have vendors that vet or verify this information. So it's not like it's a loan that's not underwritten. It is totally underwritten, just like every other loan would be. But some of the pain of getting some of the documentation together is eliminated.
Right.
So
it's a step in the right direction. Like how it'll work out, I think it all has to be told. But I think it's a step in the right direction. It does sound crazy.
Yeah.
It absolutely sounds crazy, to get an approval that fast. And I think we talked about that. It really wasn't. Do we know? It really wasn't an approval, right? It wasn't.
No, it's not an underwritten approval. So it's kind of a pre-qualification, I guess.
It's like a super, like not even just it's just a pre-qualification letter, which doesn't mean jack.
Yeah, basically it says, hey, look, you based on your income and what you're disclosing, we've looked at you got the credit score, but that all depends on the integrity of the credit, right? Because nobody's really looking at the credit. So there's some things that are on the credit. For example, when somebody does a dispute on an account, it takes that account out of the algorithm for the credit score. So you get a false reading on the credit score. And if somebody has that dispute and they get this pre-approval, that could be a little bit of a dangerous slope, because Fannie Mae asks the lenders to remove all disputes that are on people's credits. So that you get a true reading on the credit score. So I'm not quite sure how that's, if maybe they got some kind of filter in place to filter that stuff out. I don't know. But I will say this. There are these slam dunk deals that are out there that shouldn't be that painful. I mean, when somebody's putting 50% down and they've got enough cash in the bank to pay cash for the entire house, and they've got 800 FICOs, and it's an owner-occupied property, and it's a single family, it's not some kind of, weird, A-frame in the middle of nowhere kind of property. It's a, kind of a traditional type property. Those are kind of slam dunks, So there is room for this type of technology. We'll just see how far they take it, I suppose.
Yeah. Either way, it's a step. It is a step in the right direction, at least to make the process more simple, more refined, more completely online.
Isn't it interesting though that some of the backlash is that it should be hard to get a loan? It should be interesting to you, because every time
it shouldn't be easy, but the process should be the process itself should be easy. Like the qualifications and the standards should be hard. There should at least be a standard, but the process of getting all that to you guys, to the mortgage guys, and the process by which you get approved or not approved or whatever, there's no doubt that has to be somewhat streamlined and stuff. Because I think it's like that whole younger generation that's entering the housing market now, to them that just doesn't, none of that makes any sense. To especially when you got this whole young crew that, to them, whether it's like getting a ride, like an Uber ride, or renting cars, like all these things are all done from their phone and stuff. So just like with looking for homes, like on Zillow and Trulia, I mean, the reason why they're all there is because it's easy and it's accessible.
Right. Yeah, I thought it was a little fast. Most people want ease, right? They want ease of things, and to hear somebody say, "Hey, it should be hard," was a little bit of it took me back a little bit on that. But I agree with you. The process should be easier. It's kind of like the immigration law, right? I mean,
it's exactly. I was just going to say that too. It's a lot to say. You want to bring people into the country. I think everyone knows that. It's just that the reason why you have so many illegals is because the process fucking is a pain in the ass. If you try to do it legally, you spend tens of thousands of dollars and years trying to get in. And of course, if you make it that difficult, but then make it very easy also to just sneak in, and then live here. It's just, you're just creating the problem.
Right.
Yeah.
Okay, so now FHA's recently announced that the mortgage insurance for the life of the loan is here to stay. That is not going anywhere. There was some talk on our side of the fence that FHA would kind of revert back to its old. They took the mortgage insurance premium. For those of you who don't know, it used to be like 0.5%. It used to be pretty low when getting an FHA loan. And then when everybody started using FHA to obtain a mortgage because of some of the issues they may have had in the past, they raised the premiums because they just couldn't fund themselves. They weren't raising enough capital to insure America, if you will. And then they took the mortgage insurance and made it so that it's the life of the loan. So you either have to refinance the home and get out of the mortgage, get out of the FHA loan, or sell the home to get out of the mortgage insurance. Now, and mind you, before too, they had a 15-year mortgage. If you had, put 22% down, you didn't need mortgage insurance on FHA. There was some little quirkiness about FHA that they just said, hey, flat, we're having mortgage insurance no matter what. And now they've come out and said, hey, we're looking at it. There's no way we're not going to eliminate mortgage insurance or revert back to our old ways, even though the housing market is somewhat stabilized. So I thought that was it's kind of one of those things. Once gas prices go up, or once your airline ticket goes up, it never comes back down. Well, even though
do they actually make any money on it? Is it a profit center?
No, George Bush, fuzzy math. Who knows? The spreads and everything on the secondary market on FHA loans, the yield spreads on those deals is much higher than what it is on the conventional side. So because it's a government insured loan, and the government's not going to go under. Right. So we still have this bad taste in our mouth on the secondary market. So the spreads are there. Whether or not FHA is making money on them, I don't know.
Yeah, that's interesting.
Companies are, though, like Wells Fargo, Bank of America. Right. We do. I mean, the spreads on those deals are pretty hefty. So, this is something that I wanted to touch base on. We had this whole thing. I think it was last year. It was kind of a campaign, really, about raising the wages or minimum wage for workers, and having people don't have enough money to spend, and so on and so forth. There's now in our world on the mortgage side. Now, as a realtor, you're typically paid on a 1099. Most realtors, anyway, right, are paid on a 1099. On the mortgage side in the state of Arizona, I can only speak for the state of Arizona because that's where I hang my license. We are paid an hourly rate, and then we have to pay that hourly rate back based on commissions. So it's a draw. In companies, even though our job is more than 40 hours a week, I mean, your realtors are calling us on the weekend. They're calling us on Sunday, after hours, whatever. We don't log those hours in as work time, even though technically it is work time. There is now legislation out there that is going to make it mandatory that loan officers log those times in and companies pay for that overtime. Right now, companies that I work for, whatever, are getting a free pass. They don't pay loan officers overtime.
Is that just an Arizona thing, or?
No, it's a national thing. I mean, and I don't know all states, but I think California is the same way. When you work for a company, I hang my license with the company, similar to what you would hang your license at Remax or something like that. But because I'm W-2'd, the company has to pay me something for my time. I'm not 1099.
Right. So, okay, I guess it makes sense.
So they don't pay me overtime for it.
But
you get an hourly rate. It's not like we get a salary plus bonus or commission. It's hourly rate.
And then you have a draw that just says like you're taking this much out, or it sounds like it's a complicated hybrid of it all, right?
Yes, dude. And I believe in the KISS, acronym, keep it simple, stupid. Yeah. And this is like.
So what's going to happen? They want you guys to keep a log, like a truck driver kind of thing, like how many hours you've got on all this stuff, so you can calculate how much time. And are you keeping a log like once you go over 40 hours, you've got overtime.
You can't. Companies right now, companies won't pay you. Well, they will, right? But you have to get an exception through your employer. Most employers,
right?
Because it hits their bottom line, right? When you pay, your loan officers get paid $8 an hour on a draw on their commission for most companies. Now, if you work for Wells Fargo or something like that, you probably get paid a salary, and then you get lower basis points, and that's how that may work. There's many different variations to this, but most of the top-notch loan officers who work for companies, they want the commission, not the hourly rate. They could care less about the hourly rate.
Right.
They want the commission. So now what they're proposing right now is that everybody knows it's not a 40-hour-a-week job. Yeah, companies are paying employees 40 hours a week and then leveraging, if you will, the time that they work above that as non-paid.
Right.
And so they're coming out and saying, okay, you're going to have to start paying overtime.
So this is, actually, it does sort of make sense. It favors the mortgage brokers, and not in a bad way at all. What's the sentiment there amongst the mortgage brokers? They for it? Do they care? Are they against it?
Here's what would happen. Okay, this is our fear: is that okay? You start paying me overtime. Does that mean that the rates go up and the consumer ends up actually paying that overtime? Do I go to the realtor and say, "Hey, let me clock in before I can get you that pre-qual here on Saturday morning"?
Yeah.
The service aspect of it is what's troublesome. The money aspect, really, I don't think really people care.
Do you think they would? Okay. So what you're worried about is what would happen on an operational level. If something like that went through, you could get mortgage brokers where that would just start working Monday through Friday or Tuesday through Saturday and stuff like that, and just clock in hours, and then after those hours, we're not going to be available.
We're done. Yeah. And so then the service can delay. Now, if the company say, okay, we'll pay you the overtime or whatever, okay, nothing comes for free, right? So, okay, you pay me my overtime. Does that mean that my rates with your company then become non-competitive? Yeah. Because there's going to be a certain element of a certain number of loan officers that don't close enough to cover their draw.
Right. So, and then you're not necessarily going to be able to charge that back to the client with all the new rules and everything in place. It's like adding extra fees and stuff like that. I couldn't, with all the CFPB stuff, I couldn't imagine putting on an overtime fee.
Yeah, you can't do that. So the company eats it, right? So the company has to eat it. And where's that come from? Well, they just mess with the rates.
Yeah.
To increase that spread a little bit to cover it. That's what happened with appraisals. Let's face it. I mean, appraisals now are, $450, $500. Before these sort of rules came into place, they were $350.
Yeah.
So it's going to get passed on to the consumer and make it more expensive. I'm not sure what's going to happen there, but it's significant. I mean, when you add in the overtime, most loan officers, the good loan officers, because of all the things that you have to do in a loan. Yeah. If you're closing, 5 deals.
Yeah, you're doing more than 40 hours a week. You're doing
absolutely.
You're doing what do you think you're at? 60?
Yeah, I'm probably about 60.
Around there. Yeah,
probably around about 60. Yeah. Now with my podcasts and everything like that, I'm much higher than that. Probably around 70, 80 hours a week or whatever. But it's 24/7, right? I got some realtors that call me and say, "Hey, if you don't answer your phone on Sunday, I'm not doing business with you." Because I do most of my business on Saturday and Sunday. So, maybe the Rocket Mortgage or that type of technology will take some of that pressure off the loan officer. I don't know. We'll see.
Yeah.
But belly to belly, face to face, nose to nose, that's kind of the business model that we live in. And I think we should.
And we talked about that a few times, that the one of the things that's at a changing kind of thing right now is what is the role that mortgage broker going to be with all the new rules. You mentioned a couple of times that there's a lot of reasons why not to get into the business of being an LO, and getting into the mortgage business. It's like it's not something that you see a lot of people clamoring for. It's like, I want to be a mortgage broker. It's just like
it's brain damage every single day, man.
Right.
And that's the thing. There's not a lot of people replacing people like myself. Yeah. And so at some point, it's going to be one of those kind of out of business, or there's not going to be enough people to supply it. So
you have realtors having to go. You have realtors trying to fill it in and close loans.
Oh my God.
That'd be like a good comedy.
Yeah, I've been doing this now 23 years, and it's complicated. And companies sometimes make it more. Lawyers, I should say, make it more complicated. With TRID, right? We've talked about this before. You talk to 5 different real estate attorneys about TRID, and you're going to get 5 different opinions as to what you need to do.
Absolutely.
And then you have the owners of the company saying, "Okay, oh my God, I'm scared. Okay, I better do it this way. I'm going to take what the attorney told me, and I'm going to add a couple more layers onto that just to be sure." And so then you have this layering effect that really kind of restricts things too. So it'll be interesting to see what happens with this, because it's going to hurt bottom lines. You may see some consolidation if this happens, where mortgage companies start to consolidate their efforts, maybe only having 1 or 2 branches within a metropolitan area instead of having 50, to cut some costs that way. So we'll see what happens. But at the end of the day, I think the ultimate thing is going to be hurting the consumer. I always say, hey, look, just pay us $10.99 and let us do our thing.
Yeah.
But
it
doesn't work.
Again, like we talked about before, your pay and how you guys get paid and how a bank gets paid and makes money off mortgages is a changing, evolving thing right now. And it may come to the point to where if it keeps going this way, it almost seems to me like we're just going to have government stores that sell mortgages, and then you go through a lot of red tape, and you'll just have a checkup window, and you put in your paperwork there, and someone takes it all, and you take in, and the government mortgage broker then processes your stuff,
And what kills me, man, is on cars, and I don't want to get off the subject here because we talk about real estate, but in the automotive industry, has gotten away with a lot more than the real estate industry has. Yet the industries are very similar, just a different product that they're pushing. So it's kind of interesting to see. And the auto industry is a huge employer in the United States. They have some serious lobbyists,
and those lobbyists are making sure that nothing gets in the way of selling more cars.
Yeah, nothing. No way, man. Not even 0% interest, for God's sakes. In the way. Speaking of which, there was Janet Yellen spoke I think 2 weeks ago, maybe last week. No, I think 2 weeks ago, because she's been asked about negative interest rates. Some countries are having negative interest rates. I don't think that that's going to happen here. They just raised the short-term rate 0.25%. I don't anticipate that raising again in March. They meet this month, March, the middle of March, the Federal Reserve. I don't anticipate them raising the short-term rate another 0.25%. So, and in fact, based on that raising of that 0.25%, we've actually seen rates come down, oddly enough. And it was about 2 years ago. I had some conversation with some colleagues, and this is when rates were starting to creep back up. They went from 3.25, even 3.125. I think maybe 2.99 or something. I think there were a few lenders out there at the height of it. And they said, hey, we'll never see these kind of rates again. We're back on our way up. And here we are right now, almost to where we were at the best interest rates in a long. I don't know if it's our country's history, but
that ties directly to what we started at, which is the direction of the economy.
Yeah, exactly. So I don't think we're seeing negative interest rates. You may have seen that out there. I don't anticipate that happening.
It'll go low again, but it's not going to go to negative. The problem is no matter what they do, and their interest rates have to go up. They can't right now. They're artificially low, and I think that's the hesitation is that you start raising them. We trigger something to happen in the economy and stuff. And the problem with that kind of rationale though is that right now you have this artificial. It's not real right now. Like rates should be higher because of where the economy is at right now.
Right. Now, speaking of the Federal Reserve, they're meeting, as I said at the beginning or the middle of this month. I think his name is Kashkari. I think is how you pronounce it.
I don't know I don't know how to pronounce his name.
Yeah, Carey or something like that. He actually wants to break up a lot of the banks.
Yeah.
He wants to, because he thinks that if we fall into another situation, that these banks will be even bigger than what they were before, and they will definitely be too big to fail. So he'd rather take care of it now rather than face it later. And so I thought that was kind of interesting. Not an interesting concept necessarily, but it's the timing of that is kind of interesting to me.
Well, and it goes again. All the mess that was created in 2008, none of the problems that got us there, other than some of the real obvious ones, like we don't give mortgages to just anyone with a pulse or a social security number. So they fixed that. But you don't have the fundamentals of the economy, like none of that has been fixed. And there is a problem with the banking sector. There's a legitimate problem there. And with the too big to fail is a really scary thing. And there was a lot of consolidation after the crash. And and there's a lot of argument about, we saw a lot of the local banks close up or get swallowed up by larger banks and stuff. And I think that's if you had to compare to some, it's sort of like in the sea, you have like this ecology that goes on with you got the whales and the sharks at the top end of the food chain, and all the way down to the bottom you got like the snails and the little photoplankton that lives in the water and all that shit. Those small banks all going under and being bought up, I think that has some kind of residual effect in that you just consolidates more power into those larger institutions. And that's a scary thing. That's a really scary thing.
Absolutely. It is totally scary. And now the one thing that he doesn't have a vote until 2017.
Mm-hmm.
But he does participate in the deliberation
yep.
and some of the conversations that are happening. So because of the way rotation works, he doesn't have a vote. So, but I'm sure he's bringing it up in conversation, and it first starts with the conversation, and then it turns into action, I suppose.
Yeah,
but maybe it'll never happen.
Well, but again, they're targeting. There's a legitimate reason why they should target banks, but it just seems like more of a political motive. The way he's and I just think there's more of a political motive there to just go after banks, and banks are the bad guy. And they kind of simplify the issue like that, and it's just not that simple. I think.
Well, make no mistake. I mean, the banks are making tons of money right now. Tons of money. If you can afford to pay $1.2 billion and your stock price doesn't move one smidgen, in fact, goes up even. I mean, come on. I mean, that's a significant number. And we each month we go over these like huge numbers. I think one was 3.6 billion or something like that. Right. I mean, these are big numbers. So they're making money.
They're making money, and then the next question becomes like you don't want, if we all realize or we all recognize that too big to fail is bad, like having all the banks or having a small concentration of the banks run a majority of the economy or have their finger in the economy is not a good thing. Like we all recognize that, right? Where it doesn't matter like what political side of the argument you're on, but we have fewer banks today than we did prior to the crash in 2008. We have fewer banks, fewer mom and pop banks, fewer local banks, fewer, what do you call the local banks again? Is it the community banks, right?
Yeah,
so we have fewer community banks, and we have, and the big banks are larger than they were before the crash.
But here's the thing. Here's one thing that I will say. They are taking a smaller share of the mortgage market or of the real estate market. Mortgage bankers or smaller, mid-sized mortgage brokers, if you will, they represent about 60% of the originations in mortgage lending right now. So before they were about 40% and banks were about 60%. Now it's flipped. And I think banks are actually like at 30% or something like that. Credit unions are like at 7%. And then there's miscellaneous in there. So mortgage bankers like myself, we represent probably the vast majority of the originations that are happening out there. So banks are losing a smaller share, yet they're actually able to afford these big fines. So what does that tell you about the spread?
Yeah, you're exactly right. I totally agree with you. And then, but that's the exact reason why there should be more banks wanting to get into that business. Like if there's profit being made, and more competition is ultimately a better thing for the consumer as long as you've got the proper regulations in place.
Hey, a funny little not story, but I saw it yesterday. Trump actually wanted to have his own mortgage company in 2007 or something like that.
Under,
He's like, it's a good time to be a mortgage banker.
Yeah, I heard that.
And then it fell. So maybe he'll jump into it and say, "Hey, I'll make mortgage great again, and I'll buy it all."
Well, he had a mortgage company, didn't he?
I wasn't aware of it.
Or he had so many businesses that failed. But I know he's got the other comment out there where he ripped on real estate agents. I think he said that they were all bloodsuckers. I think it's what he said. So.
And then he made a weird face and shook his hair and walked off.
I'm not a Trump fan.
Okay, and this isn't a political show either. The other thing we mentioned, like I think it was January or maybe it was December. Google Compare.
Yeah.
Right. Do you remember that where people can compare airlines and they were getting in the mortgage business and right? Well, they pulled the plug on it.
Did they?
Yeah, they pulled the plug on it. So you can no longer Google Compare to find the best interest rate available. They're leaving that up to, I guess, Lending Tree or something.
Okay.
I don't know. So they pulled the plug on that. That was a bit of a, I don't know if that's good. It wasn't very good anyway. The way they had it set up,
Google gets in and out of a lot of things, so it's not, like I said, they get in and out of a lot of different projects and everything else. They're
last thing I have here, first-time home buyers. A lot of reports out there. First-time home buyers are ready to buy, but the builders, in particular, aren't really. They're holding back. Builders still aren't 100% confident. Probably because of the things that we're reading about the economy and things like that. Yeah. They're not willing to buy all this land and sit on it just to anticipate first-time home buyers hitting the market in droves or millennials hitting the market in droves. So I guess the point being here is there seems to be quite a bit of demand, but I personally think we have an affordable housing issue here in this country. When you have all these suppressed incomes, $15 an hour or whatever, cost of living is high, and there's not enough housing, affordable housing to meet that demand. So builders aren't putting out a product either necessarily that's tailored for first-time home buyers either.
Yeah, well, it doesn't make sense for them to. That's the problem. Again, it's so funny. It's like so many things we talked about here all kind of cross over that theme over the economy. And, that's the one thing that really should be front and center in all these silly political debates. Like they're talking about it, but
nobody's talking. Well, Clinton did talk about housing.
Yeah,
I'll give her that. I'm not one side or the other. But she did speak about housing in the United States, and there needs to be better housing options in the United States. Oh. And if you remember, her husband, was kind of the spearhead, or a lot of people anyway, credit him for back in the when he was president that it kind of loosened up the guidelines. It kind of, paved the way for.
Well, he did. Like I said, it gets complicated, but if I got it right, he opened up the door so that it had to do on the back end and how you bought and sold, how companies bought and sold mortgages, right?
How they were securitized and stuff like that.
Yeah, exactly. Yeah.
So you could take a stated income loan. See, before these loans had to be put in each category. So if you had a stated income loan, it had a risk factor of whatever, and it went into that pool. And then if you had a Fannie Mae deal, it went into that pool. And then if you had a FHA deal, it went into that pool. Right. Well, you eliminate all that and everybody just put it all in one pool, right, essentially. And so then you have bad loans mixed with good loans, or what they quoted as bad loans and good loans. Yep. And then because the return on those was so good and so high, the yield on those, there was a huge appetite out there for municipalities to buy these securities,
Exactly.
so they didn't have to raise the taxes on their citizens,
Right.
and it was a big political thing.
Right.
And campaigns were won based on that. And police and fire departments got new equipment based on that. They got all kinds of stuff because they didn't have to raise taxes, and they could live off the interest on these securities.
Right. And those securities were never meant to be. They were never meant to be sold in that kind of fashion. They were supposed the way it was set up since the Great Depression. But what do we had like a 70-year run where when that system was the secondary market system was created, where you had you lined up the banks would sell those mortgages off to investors that would hold these securitized products. But there was like I said, it goes way complicated. I understand, other than the fact that you could not, like what you just said, like a city couldn't buy those kind of assets so that they could fund their pensions with and stuff like that, which is what ended up happening, right? That you had
absolutely
like cities, school districts, police departments, fire departments, they all bought those securitized assets and wanted those to fund pensions and healthcare costs and everything else.
And build new parks and all the other things that they wanted to do.
Yeah.
Absolutely. It was a way for them to do that. So, it was a big deal, and he kind of paved the way for that to happen, which encouraged more home ownership because these loans could get sold, which means then banks were making a lot of money on them. So they were willing to take more risk in certain areas, which that happened. And it just kind of led this down this slippery slope. So the fact that she mentioned it, I'll give her 100% credit there. I think housing needs to be a topic of conversation in the campaign. 100%.
It should be, but then on the flip side, like where she's going with that, whenever the politician says affordable housing, what they're talking about really doing is making housing affordable by issuing credits, so that they can have their hand into it and issue, here's a family credit, per month or per year or whatever, so you can have affordable housing.
Yeah. Okay, so that's what I have. I have a couple others, but they're kind of, they're not really big. They're kind of small newsmakers. But you had something I think you wanted to mention about
Zillow. I think one of the biggest things that's happening right now is that you have the Zillow and Trulia Godzilla monolith of listing searches. And so this week, or not, it's actually last week, Zillow introduced Zillow Video. And so it's a small feature that goes on to the profile of a Zillow listing if the agent has a premier package. And it puts the video front and center of the listing when someone's searching through listings on Zillow. The reason why it's such a big deal is that it's going to be a huge enhancement to the viewing experience of a buyer when they're searching for homes on Zillow. And what we're talking about is that you got the Zillow Trulia Godzilla giant that it is far surpasses Realtor.com and Redfin and every other website out there. And a move like this, if they do get agents to start submitting videos into it, all it does is it solidifies more that relationship that the buyer has now with Zillow. And when we start talking about that, it kind of ties into some of the stuff we talked about earlier, in that you have buyers want a very simplified process. Like we talked about the mortgages, they don't want to go through. They see the mortgage process being super complicated and very difficult. It's the same thing when they're searching for homes. They want it simplified. They want to see the whole house and be able to view the whole house online, and then make the decision where they actually want to go see it themselves, like physically. And so this feature here is a move in the right direction, but it's a move in the right direction, good for Zillow. Not really good for real estate agents, though, in terms of Zillow continuing to solidify its dominance over listing searches. So it's a fascinating thing to watch, this whole thing unravel. And then the other thing is Earl Samuelson, who is the guy that he is the chief marketing officer or chief industry specialist, something like that at Move.inc, which is owned by Realtor.com. He's the guy that jumped ship, moved over to Zillow. They did announce that his court case is going up on June 16th. So
Yeah.
there's millions and millions of dollars in lawyers and injunctions and all sorts of legal crap
Well,
to hold that guy from working at Zillow.
oh, tons, man. And here's the thing: they announced their fourth quarter earnings last month as well.
Yeah.
Zillow,
Yep.
or Trulia, whatever they are now,
Yeah, Zillow's
and they lost tons of money, and they chalked it up to
yeah.
the fact that they had to pay all these attorney fees and legal fees and whatnot.
Yep.
And they even announced that they're going to raise the rates or raise the fees to realtors to help pay for it.
Yeah.
And I spoke to let's see here, two realtors that I spoke to last month that actually use Zillow for lead generation or getting leads or whatever. One is spending over $1,000 a month. The other one is spending about $400 a month, and they're getting zero from it.
Yeah.
Zero from it.
Well,
but they're in a contract, so they have to pay it. And here's Zillow saying, "Hey, guess what? I'm going to raise that on you, and you're going to like it because I got to pay attorney fees because we made a mistake. You know, we hired the wrong person or something." It just seems counterproductive to me. I think Zillow is in big trouble.
Well, they're
big.
Yeah, they're big and they have a lot of dominance, but they do have to start. They spent a lot of money. The legal stuff that's going on, and they did the acquisition of Trulia was like $2.5 billion. So they've done a lot of acquisitions. Obviously, the Trulia one was the largest, but you are right that they do have to start making money, and that is going to come from realtors and mortgage brokers that they're going to squeeze out as much as they can. So that's all happening. And I think what I've been kind of telling real estate agents in a lot of my speeches is that really the end game is that they are going to start selling not just the connection. Right now they're selling the connection. So a buyer looks on Trulia, they want information, they contact a realtor. The end game is that Zillow will end up qualifying those leads themselves and then selling that qualified lead to the real estate agent. And when that happens, that's going to be sold. We're talking now like that's like a 20%, 30%, 40% referral fee they're going to be charging for that. That money, what you're saying, like that hole, they need to fill that, and they are going to fill it. They're a company just like any other company. They're not doing this for free. And I think that is where it's all headed. That's why I think the video thing was such a big deal.
Yeah, that's good. I mean, video, we talk about video all the time, right? If you're a realtor and you're not doing video, you're going to be behind the eight ball here very quickly. You're not already.
Yeah.
So you got to do video. Got it. Now, I did forget to mention one thing, and I said I'd mention at the beginning of the show, and that was the changes to desktop underwriting. I mentioned about the seamlessness or being able to pull information, pay stubs, that sort of thing. DU did announce here recently that they will start underwriting and getting automated approvals with borrowers with no score. So if you don't have a credit score at all, they'll be able to underwrite your file or give an approval based on your profile. And that's going to be based, I'm sure, based on length of employment, length of residency, maybe your rent history or what you're paying in rent versus what you're going to pay in a new mortgage. You know, if you're living with mom and dad and you have no credit and you're getting a gift from mom and dad to purchase a house, you're probably not going to get approved. But if you're somebody who is paying rent, you pay cash for everything, and you're paying $1,200 a month in rent, and your new house payment's going to be $1,000, and you've got a 401k, and you've got 5 years on the job, and your debt ratio is in line. The only thing you're missing is a credit score. You're probably going to get approved, and that's what Fannie Mae and Freddie Mac are looking to try to accommodate. And so we talk about, the restrictions and tough getting a mortgage, but Fannie Mae and Freddie Mac are looking for ways to pull more individuals into home ownership. Now, with the release of this is going to be released June 25th. So we're, it'll be the second quarter of this year. But with that release, they're also integrating in, and we talked about this before too, and I want to make sure I get this right. That they will start, I'm just going to read it here. Fannie Mae is implementing DU version 10.0 the weekend of June 25th. Perhaps the most notable feature will be its ability to underwrite borrowers with no score and no traditional credit. Approvals will be limited to one unit, primary residency, where the LTV is no more than 90%, so 10% down. And the DTI is less than 40%. Debt to income ratio is less than 40%. With 10.0, Fannie Mae will also introduce trended credit data. We spoke about that when people pay off their credit cards instead of having them maxed out.
Yeah.
Fannie Mae is promising it will be more restrictive. It will not be more restrictive, but it will be less restrictive. FHA and VA through DU will remain the same. So FHA government-backed loans aren't going to change with this change, with these updates. Fannie Mae will begin treating all late payments equally rather than putting more weight on mortgage lates. So they also made the announcement that mortgage lates are going to be treated the same as a credit card late, or a credit card late is going to be treated the same as a mortgage late. We don't know which way, but they're going to treat all lates the same, difference. Right? Yeah, there's a big difference. So I applaud them for taking some steps to try to encompass more people into home ownership. I think it's a good thing. And I got to say, man, I think they're doing it right. I think they're rolling out slowly, kind of testing the waters a little bit with some of these things. Now, this is where we get into some overlays and things like that, because Bank of America announced too that they're going to start doing 3% down loans where they weren't before. That's been out there for quite some time. 3% down on a conventional deal. With this rollout, we'll see if every lender adapts what Fannie Mae is trying to push. And if they don't adapt to it, then we're going to see those overlays kind of pop, right?
Yeah, I think that would make the most sense.
Yeah. So that was one thing I wanted to get out there.
It's again, I think it just ties into everything. It's so much of a wait and see kind of thing, because there's a lot of stuff happening like that right now that I think is going to have when you talk like that, it doesn't make me feel all warm and fuzzy for the future of the real estate industry, just because I keep seeing things that are putting us back into putting us back in a situation slowly that we were prior to 2008. And like I said, I get that with the credit, like not using the credit scores, because like we had that one, your buddy on the other day was awesome, talking about credit scores, and it was like a whole crazy thing, in terms of like being able to fix your credit score with the right types of activities and stuff like that over a year. And does a credit score really represent your credit worthiness to borrow money to buy a house? The thing you're talking about with the millennials, I think with the millennials, what they really want is a different type of mortgage product altogether. So I think a lot of them see that they're not going to be living in that house long term.
Yeah,
they want the tax benefits of living in there, and they do want a home as opposed to an apartment, but they also don't plan on living in it for 30 years. They don't understand why you have to have that loan for 30 years. I think they want some type of like a temporary loan type product that they can just quickly get in, purchase it if they can prove that they can pay it, and then be able to get out in 2 or 3 years or whatever when they move on to a new job or whatever. I think that new generation wants to have that flexibility to be able to get in and out of properties quickly.
Well, I'll say this, and I only speak here I'm in Phoenix, Arizona. I think there's a little bit of an attitude change when it comes to real estate. It's not so much. I think people are looking more long term. At least the people I'm speaking to, because I ask them, "What are your long term goals with the property?" And most of them are saying, "Hey, I'm going to be in it 10 years, 15 years, whatever." So I think there's a little bit of a shift going on. We'll see what happens. Time will tell. When you get pay raises and all that kind of stuff, your attitude toward money a little bit, changes. So we'll see. Hey, I want to answer some questions here though for Amy. Amy has asked here, and thank you for providing the questions here, Amy. Hey, I'm looking to buy a home. Know of any good websites to look over? I guess it depends on, are you thinking about the mortgage side or the financing side or the real estate side? If you're looking at the real estate side, I would probably recommend Realtor.com for the properties over Trulia or Zillow or even Redfin. Those sites, Realtor.com is straight from the MLS. They have a proprietary link to your local MLS, so it's real time, where Redfin and some of these other third-party sites, if you will, don't have that access. So some of the information you may be getting on there as far as a property, whether it's sold or listed or the price that it may be listed for, could be outdated, even though it was just listed yesterday. So I recommend Realtor.com when it comes to searching for actual properties. When it comes to yes, and I'll get to your questions. You're asking some great questions here, Amy. When it comes to a mortgage site, there's tons of them out there. I'll tell you this from my experience. I probably would get with a realtor first and have them recommend a local professional loan officer in your area. Rates do vary across the country, and some lenders use the bait and switch tactic, where they will post rates on a website like bankrate.com or LendingTree, and they try to keep that integrity intact. But a lot of times they overpromise and underdeliver on those. So I would find a realtor first and foremost. And there's many ways to do that. Finding a realtor, maybe talk to friends, family, whatever. Search them out on the internet. Once you do get a name, look at their history. Ask them some questions about who they represent. Are they a luxury market realtor? Are they a first-time homebuyer realtor? Interview the realtor. I can't stress that enough. No, and any good realtor is not going to be offended by that. In fact, they're going to appreciate it. Well, yeah, the idiots will. And if they are offended, fire them right away. Yeah, you're right. You're right.
That's why.
But any realtor that's worth anything is not going to be offended by that. Yeah. Don't just say, "Oh, my friend recommended you, so what can you do for me?" Okay, let's do it. Let's write our contract. No. Ask them how many transactions they
get a good,
all that kind of stuff. Anything you want to do, or anything you want to ask
the next 3 months with them, helping you find a house, and only to find out that they suck. You really got to do your research and interview everybody.
Amy, on this question here, do you think home prices will go down or up? Is now the time to buy? This is kind of a hyper local question. Here in Arizona, prices in Phoenix, Arizona are actually going up, but even it depends in Phoenix here, even in the price range and even in the location. For example, on the west side of town here, where the Cardinal Stadium is, prices are going up and getting multiple offers. In Scottsdale, where the prices are a little bit higher, it's actually kind of leveled off. They're still increasing, but not at the rate that a first-time home buyer market would be. And then we're starting to see even trends here in Arizona when it comes to condominiums and townhomes and some of the other different types of property they may be looking for. And they're appreciating a lot more because they have a broader audience. There's more people that can afford those homes. So that's a tough question to answer. In some markets, like maybe New York or California and San Francisco, where the average median income or sales price is $1 million, it's kind of hard to say that those prices wouldn't come down. I can tell you, though, in Phoenix here, we are still, right now, even with our prices the way they are, we're still about 34% below the height of the market back in 2007. But our average income is also down, right? Not everybody's making the same kind of money they were making back then either. And we actually have a shortage of supply here a little bit. So I guess that's a tough question. Good question, but that's definitely a question I would ask your local realtor. And I don't know where you're at, Amy. I don't know what part of the country you're in. But that'd be a great question for your realtor. And then she disagrees with you that she's looking to stay in one place. So she kind of, Amy's saying, "Hey, look, I'm looking for a long haul." And I think that's a trend I see, man. I see a lot of people saying, "Hey, look, I want to get married in this house. I want to raise my family in this house. I don't want to deal with the moving." Granted, that's where we are today. When somebody gets a raise, that's 100% above whatever they're making right now.
Stay at their jobs.
That attitude may change.
There is not. I mean, people move jobs. People have to move for a variety of reasons and stuff. But the main theme though was just that making the process simplified. I think that's what Quicken Loans was trying to do, and I think there's a lot of people that want to see the whole process just streamlined and made a lot simpler. But it doesn't mean it has to be easier to get loans, though, too. That's like we're just talking about making it the process better.
And Amy, too, it looks like you're from Oregon there. I don't know if it's Portland or we're out in Oregon, but, I do have some contacts up there in Oregon that can help you with financing if that's what you're looking for. I don't have any real estate contacts, but the gentlemen, the people that I know there in Oregon who do the financing, I'm sure have great contacts there. Excuse me. So if you need that, please reach out to me. Follow me on Twitter, instant message me, and I'll be sure to get you. You already got the money. Okay, great. I don't know any realtors there, but so I can't help you there. I'm sorry about that. And Jorge here, he's in Chicago.
I think we're at 7. We're at 7:22.
I think. Oh,
yeah.
7:22. What is that?
Oh
mean?
yeah. Six, but
time?
yeah, we
I'm at 6:22, brother.
Time right now.
And Amy is at 5:22. She's an hour behind us. I thought for some reason we were going to change time this weekend. When is the change time?
Yeah,
when does that happen? Isn't that soon?
I have no idea.
I thought it was this weekend. Am I wrong?
Yeah. It is coming up, though. It's always around Easter time.
Hey, Thomas, we'll get to your question here in just a second, buddy. We're going to try to end this. We'll do a little after show here or whatever and talk to you about that. But I'm Jayson Bates. I host a podcast. You can check it out on iTunes called Valley of the Sun Real Estate Show. Valley of the Real Estate Show. That's the name of the podcast that I host. And it's all about real estate here in Phoenix, Arizona. And you can check it out also on my website by going to www.valleyofthesunrealestateshow.com.
George Cuevas from
Jorge, give your plug, brother.
Real Estate Marketing Show. That's it.
All right. I don't know if I'm broken up or I don't know if I'm losing internet or what's going on, but I'm frozen in time right now, brother. All right, cool. Thanks, guys. We're gonna.
All right. You're coming.
Yeah, I'm frozen. Maybe I'm not on your end, but I am on mine. All right, cool. End this right. Yeah. Okay, good. Cool.
I'm gonna pause.
We're gonna stick around though. We're gonna stick around.